markets are doing something interesting. Futures are up this morning, the Dow is pointing higher by about 54 points, the S&P 500 futures are adding roughly 14 points, and the Nasdaq is edging up around 57 points. On the surface, that looks reassuring. But what happened yesterday, and what's coming later today, tells a more complicated story. And that's exactly what we're going to break down right now. Welcome to my channel. I am Bogdan Macro, and every week we cut through the noise and figure out what's actually moving market. If you're new here, please subscribe and hit the like button. It's the single best way of helping people see this content. Now let's get into it. So let's start with what had Wall Street's attention yesterday, because it wasn't the headline index moves, it was something happening in the private credit market. A name called Blue Owl Capital, one of the largest private lenders in the United States, announced that investors in one of its retail-focused debt funds, specifically the Blue Owl Capital Corporation 2, or OBDC 2, would no longer be able to request quarterly redemptions. Let me translate that. For years, if you were an investor in this fund, you could raise your hand every 3 months and ask for a portion of your money back. That door is now closed. Instead, Blue Owl will decide on its own when and how much capital to return. Now let's look at the numbers because they tell the full story. Blue Owl simultaneously sold $1.4 billion of direct lending investments spread across 3 of its business development companies. The biggest chunk, $600 million, came out of OBDC2 alone. That is roughly 34% of that fund's total investment portfolio being liquidated in a single transaction. The buyers, reportedly, were North American public pension funds and insurance companies. The proceeds from the OBDC2 sale were used to pay down a credit facility from Goldman Sachs and to fund a special cash distribution worth about 30% of the fund's net asset value. What drove this? According to filings and reporting by Bloomberg and others, redemption pressure at Blue Owl's non-traded business development companies had been accelerating throughout 2025. In just the first 9 months of last year, $150 million was pulled out of these funds, a 20% increase year over year. And it got worse from there. In the most recent quarter, redemption requests exceeded the standard 5% quarterly cap at both of Blue Owl's non-traded BDCs. The tech-focused vehicle, OTIC, saw redemption requests spike to roughly 15% of net asset value. 15% against a cap of 5. That's 3 times the threshold. The market's reaction was immediate. Blue Owl shares dropped about 10% on Thursday, hitting their lowest level in 2.5 years. Shares of competitors also fell. Ares, Blackstone, Apollo, KKR, TPG, all of them were dragged lower. There is also an ongoing shareholder lawsuit, filed earlier this year, alleging that Blue Owl failed to properly disclose the liquidity pressure its funds were facing. I'm not alleging any wrongdoing here, draw your own conclusions, but that lawsuit is a fact of record. Now separately, you might look at one piece of this story and call it a niche alternative assets problem. And separately, you might look at Fed minutes that warned this week of a potential rate hike. And separately, you might note Walmart reporting that general merchandise inflation sharply accelerated due to tariffs and cutting its full-year guidance. Each of those stories on its own is interesting. Together, they tell you everything you need to know right now. The US economy is dealing with persistent inflation, a central bank that may be moving further from rate cuts rather than closer, and the shadow credit market that has been quietly absorbing enormous retail investor dollars, with yields advertised as high as 16% and is now showing signs of stress, precisely when rates have stayed high longer than anyone expected. Let me give you some context on that private credit market, because the number matters. This is a $1.8 trillion industry, and according to research published by Duke University's Fuqua School of Business, institutional ownership of publicly traded BDC shares has been declining steadily for years, falling to around 25% of ownership on average by 2023, which means retail investors, regular people, have been picking up the rest of that tab. They were lured in by yields that look extraordinary in a world of low returns, but yields above 10 and 11% don't come without risk, and that risk is starting to surface. Mohamed El-Erian, the former CEO of PIMCO, posted publicly asking whether Blue Owl's move was a canary in the coal mine moment, drawing an explicit comparison to the early stages of the financial crisis nearly 2 decades ago. Dan Rasmussen of Verdad Capital put it even more plainly on CNBC. When times are good, he said, cash flows cover normal redemption requests. When times are bad, requests surge and it becomes a race to the bottom. Now, this doesn't mean the entire private credit market is collapsing tomorrow. That's not what the data says right now. But it does tell you that the stress mechanism, the thing that turns a quiet problem into a visible one, is beginning to activate. And the conditions for that mechanism to keep running include exactly what we're seeing: rates staying elevated, software and tech stocks under pressure, and retail investors getting nervous. Which brings us to the data coming today. 2 critical releases. First, the Personal Consumption Expenditures Price Index, the PCE, the Fed's preferred inflation gauge. Economists are expecting core PCE to come in at 0.3% month over month for December, up from 0.2% in November. Year over year, the expectation is 3.0%, accelerating from 2.8%. The Fed's target is 2%. So if the print comes in at or above expectations, that is not a data point that opens the door for rate cuts anytime soon. Now, last week's CPI for January did come in cooler than expected, and that briefly revived bets for a potential cut as early as June. But the blowout jobs report earlier in the same week pushed those bets back toward the second half of the year. Today's PCE is the tiebreaker in that back and forth. Second, we get the advance reading on fourth quarter GDP. Economists are forecasting growth of 2.8% annualized for the October through December 2025 period, a notable deceleration from the 4.4% pace recorded in the third quarter. Consumer spending was the engine of that third quarter strength, but what the GDP number won't fully capture is the K-shape underneath it. Higher income households and large corporations have been doing the heavy lifting. Lower income Americans are still battling elevated prices, a slower hiring market, and small businesses are being squeezed by import costs, driven by tariffs and a tightening labor supply from the ongoing immigration crackdown. Walmart flagged this dynamic specifically when it reported earnings this week. General merchandise inflation is accelerating under tariff pressure, and their guidance for the year reflects that. And then there's the oil story layered on top of all of this. Brent crude was trading around $71.66 a barrel this morning, and WTI was at $66.35. Both contracts were tracking for a weekly gain of more than 6%, their best week in months. President Trump said Thursday that really bad things would happen if Iran does not reach a nuclear agreement within 10 to 15 days. Any escalation involving Iran, a major OPEC producer, raises the risk of disruption through the Strait of Hormuz, the waterway that handles roughly a fifth of all global oil shipments. Higher oil prices feed directly into headline inflation, which feeds directly back into the Fed's calculus on rate cuts, which feeds directly back into how long private credit stress can remain contained before it becomes something larger. That chain of connections is what today's data will either accelerate or relieve, at least temporarily. If PCE comes in hotter than 3% and GDP prints below 2.8, you have a stagflation signal in a market that is already jittery about private credit liquidity, and a Fed that is sounding more hawkish than it has in months. If the data comes in softer, some of that pressure releases, but conditions, not certainty, are what we can assess here. Here is my question for you in the comments. Given that institutional ownership in BDCs has fallen to about 25%, while retail investors are now holding the rest, do you think regulators should step in with tighter liquidity requirements for these funds before more gates go up, or should this be treated as buyer beware? Leave me your take below with a date. I want to know what you think as of February 20th, 2026. If this breakdown was useful, send this video to one person in your network who trades or invests 1%. That's it. And if you're not subscribed yet, now is the time. This is Bogdan Macro, and I'll see you in the next one. Oh, and before you go, YouTube thinks you might enjoy this video next, so let me know if they're right.